So what is the cash value in a whole life insurance policy? In short, the cash value in a whole life insurance policy is your money that you have access to. What we're going to talk about today is some commonly asked questions around the cash value in a whole life insurance policy. Let's jump right on into it. So again, the cash value is money that you have access to in your whole life insurance policy. Why people are attracted to the cash value is for what I like to call the core benefits. There are three of them. The cash value is a safe, liquid, and a tax-free area to position money. Safe, we've got this 3 to 5% here. That 3 to 5% represents the net growth rate over the life of a policy. When you first start a whole life insurance policy, even if it's set up for maximum cash value, you'll often still see a negative return in the early years. For example, if I pay in $10,000, my first year cash value may range somewhere between $8,000 and $9,000. So that is a loss. However, as time passes, I'll likely see the net growth rate fall somewhere between that 3 to 5% range. Historically, we have seen policies do better than that, but that 3 to 5%, in my opinion, is a means of setting expectations more conservatively. But how it's safe is that growth rate continues regardless of what occurs in the stock market or economy. A big reason why people are attracted to whole life insurance, particularly for the cash value, is because of that safety. I know regardless of what goes on in the environment, the economic environment, my cash value will continue to appreciate. I know in 2008 and also when COVID first hit and there was a lot of market uncertainty, a lot of interest was drawn to whole life insurance specifically for the cash value benefit. We've got the liquidity. I can access the cash value anytime. A unique feature to a whole life insurance policy is that I can borrow against it. And when I borrow against the value, the cash value, I continue to earn that 3 to 5% on my entire cash value. We'll look at an example toward the end of this video. And then also tax-free. So if I'm earning, let's call it 4%, I'm in a high tax bracket, say a 40% tax bracket, and that's tax-free without any risk, and I can access it like a personal line of credit through the loan feature, that's where it becomes very, very attractive. We have the word if here because there's a lot of marketing around whole life insurance in the sense that you can always access the cash value tax-free no matter what, or at least that's what some people are led to believe, or they do believe. That's not quite the case. There are instances where taxes can occur on the cash value of a whole life insurance policy. It's easy to prevent, provided we set it up right and don't trigger a taxable event. We've got more information in the video above, but I always like to throw that in there. This way, no one's misinformed in the sense that I thought it was tax-free and then I find out after the fact that it's not. So who uses this? Who uses whole life insurance specifically for the cash value? Another way to phrase this question that I really, really like is, why would someone buy a life insurance policy for something other than the life insurance? I'm buying it for the cash value. Why would I do that? So here's a couple examples. We've got wealthy individuals that have used whole life insurance for a long time. The life insurance is important to them. Often you'll see that used for legacy planning. The death benefit's paid income tax-free. You can use it in estate planning cases and such. You'll see trusts involved. But focusing on the cash value, here's how it is often viewed. The cash value is viewed as a fixed asset class. Some have expressed that they view it almost as a bond alternative. It is safe money. Going back to that first core benefit, I know the value will continue to appreciate over time no matter what. Number 3, I've got access to the cash value for opportunities. It is very easy to access. Some express that it feels like a personal line of credit that I can use almost as my own source of financing, or I can use it as my own source of financing. Earlier today, someone had reached out. He has a very large whole life insurance policy. He said, I've got a real estate opportunity available. I'd like to borrow about $160,000 against my life insurance policy to take advantage of this opportunity. We send the paperwork. He signs off on the loan form. That's it. It's very, very quick. He gets the loan within 3 to 5 business days, and that's it. And he can pay it back however he'd like. So that's very attractive to individuals from a ease of access standpoint. Corporations view the cash value as an asset on their balance sheet. It is used in executive benefit planning, deferred compensation planning, also in buyout agreements. There was a law firm we recently spoke with. A partner is potentially looking to fund his retirement buyout with a life insurance policy. We're still in the early discussions there, but my point is it's brought up, or I should say the cash value is used for that type of planning among corporations and small businesses. So how to build it, specifically, how to build the cash value, meaning when you're going to fund the policy, if I think of a bank account, how do I build my bank account value? I add money to it. So how do I build the cash value in a whole life insurance policy? Well, I add money to it. The item I want to be aware of is that I can add money either to the premium portion of the policy or to this guy, this Pua Rider, which means paid up additions. So we've got premium payments / deposits. Same thing with PUA, payments / deposits. You can call it either one. Technically, it's a payment, but some like to use the word deposit because mentally, I feel like I'm depositing money into the policy and I've got cash value I have access to. But as I look at the two areas, I've got premium dollars. Premium dollars will first satisfy the life insurance benefit and second, satisfy the cash value benefit. Premium dollars also result in high commission to the agent. PUA dollars satisfy cash value first, or I should say, when individuals take out whole life insurance and they're interested in maximizing the cash value, how that's done is by putting less money into the premium and more money into the PUA. The paid up additions rider will buy some life insurance, but typically for individuals maximizing this component, the life insurance benefit is secondary to them. And the PUA rider does result in lower commissions. I will say, in the life insurance industry, when I worked for other individuals, there is a culture of earning high commissions where that gives you the most bragging rights, where you've got a high status if you're writing a lot of premium that results in a lot of commission. And I only say that because if I'm a consumer interested in a policy for high cash value, that will result in what? Low commission. So in many ways, the industry is incentivized to sell products that are not set up for high cash value. Not saying all agents do that, but it is something I definitely want to be aware of if I'm a consumer. So let's look at an example policy here. We're going to look at the same policy, but two different examples. In green, this is your money, specifically your cash value. And then in blue, we've got what you're paying every year, $10,000 per year in this case. We'll look at a high premium policy first. You're funding $10,000 per year. In the first year, your cash value is zero. This would occur if you have what I like to call an old school whole life insurance policy, meaning it's a policy where all of your money went toward the insurance premium. This is referred to as the base premium on a whole life insurance policy. If that's the case, you'll have zero or a very small percentage of that premium in cash value in the first year, sometimes the first and second year. By the fifth year, you've paid in a total of $50,000, but your fifth year cash value is $35,000. Not good. By the 10th year, you've paid in a total of $100,000, $10,000 per year for 10 years, and your cash value is $90,000. Not attractive at all, is it? No, this is a high premium policy, and what high premium represents is that with respect to the total dollar amount you're paying in, the majority or all of your payment is going toward the premium. Now we've got a low premium policy, and this can be the exact same policy with the exact same company, just set up where the agent is reducing the premium and putting more of your dollars toward the PUA component. What happens now? You pay the same $10,000, but your first year cash value is $8,500. By year 5, you've paid a total of $50,000. Your cash value is $55,000. You're cash positive already. And then by year 10, you've paid a total of $100,000 and have $115,000. A quick side-by-side example of this is right here. Here's what we just looked at. $10,000 per year for 10 years. On the left, we have a policy where all of the individual's money is going toward the premium. By year 10, just about $90,000. And it's by year 12 when he has more money in cash value than what he's paid into the policy. Versus this guy, we've got a low premium policy, $1,000, $9,000 toward PUAs. We also have what's called a term insurance rider here. Well, what's the difference? Break-even point, year 4, by year 10, a little bit more than $115,000. So again, the same product with the same company, but a different design. Let's continue on here. Some other questions we receive around the cash value. How does it grow? So specifically, what am I getting from the insurance company, or how are they growing my money? Because when I give it to them, they're doing something with the money to generate a return higher than what they're giving me, but I'm putting my money with them because they are going to grow it. Yes, this is why people are interested in it. So a couple of components drive the growth. I've got the guaranteed rate. That will range between 2 and 3.75% with new products. If you have an old product that you started before the year 2022, you likely have a 4% guaranteed rate. But you have the guarantee plus whatever the surplus rate is. When you add the two together, you have the total dividend rate. And an easy example of that could be a product with MassMutual. And I say that because in 2023, MassMutual's dividend rate is an even 6%. If you go with a product that has a 3% guaranteed rate, what that means is the surplus is also 3%, because I take the guarantee plus the surplus, and that gives me the total dividend interest rate. Usually the insurance company will tell me what the dividend rate is, then I can back into the surplus. For example, MassMutual let us know that their 2023 dividend rate is 6%. So if I go with a product that has a guaranteed rate of 3%, which I'll know, then I know the difference is the surplus. An area of confusion around dividends and guaranteed rates is that they are always a gross rate. So for example, if you have a MassMutual policy, we'll stick with them as the example, with a 6% dividend interest rate, and you have $100,000 in cash value, naturally, what do you think your cash value is going to grow by that year? 6% or $6,000. However, that is not the case. You'll never see that happen. The reason why is because anytime we see a dividend rate, or guaranteed rate for that matter, that is a gross rate that is applied to the policy after the insurance expenses. What I want to look for is the net rate, and the terminology that is used by the insurance company, you can request this from any life insurance agent, is the internal rate of return. I can request the annual IRR, internal rate of return, or the average internal rate of return, which would be the yearly growth rate or the average growth rate, really, when I look at it. Another question, how do I access the cash value? There's two ways. I can take out a withdrawal, which is like withdrawing money from a bank account. Once I withdraw it, it's gone. You can no longer earn interest. Side note, when it comes to withdrawals, typically don't want to do that during the first 7 years. That's one way you can potentially trigger a taxable event. Another way we can access money is through a loan. Now, questions that come up with loans is, do I have to pay it back? The answer to that is no. However, it often makes sense, especially during my working years. But if I'm taking income from a retirement standpoint, I'm probably not paying the loan or any loan interest back. We've got other videos that really go into detail there. How do people use policy loans? This is really the question that comes up. And going back to that line of credit feature, access to the cash value anytime, that's often how. So an example here, we'll blend it with this question. Do I pay interest on the loan? The answer is yes. However, what I want to keep in mind is that I also earn interest, specifically dividends, on that outstanding loan. Really, my entire cash value. The best way to illustrate this is with real estate, and this will tie back to this question with respect to how people use them being these policies with policy loans. So let's assume you own a piece of property. It's valued at $100,000 and the appreciation rate is 5%. You elect to borrow $50,000. Let's assume it's a line of credit. You've got a cost to borrow, interest, that goes to the bank. That 5% appreciation continues to occur on your entire property value. So the fair market value continues to increase. With a life insurance policy, it is very, very similar. When I borrow against it, I have a cost to borrow, loan interest, that goes to the insurance company. However, they continue to apply dividends and interest on my entire cash value. Example, you had $100,000 in cash value, you borrowed $50,000, you keep earning dividends and interest on the full $100,000. That's where people are often attracted to it, because when I repay that loan, I see my value restored to what it would have been as if I never touched it in the first place. Pretty neat, right? Now there's more to it with the death benefit and how that works and such, but that's a quick overview there. And what I'll say too here, just with paying interest on the loan, do you have to physically pay it out of pocket every year? No, you don't. If you have a loan interest bill that comes due and you do not pay it, provided there's sufficient cash value in the policy to cover that loan interest, it can be paid by the policy. Now that will have an impact on your cash value. You'll see the death benefit come down a little bit, but sometimes people will do that. They'll defer the interest and then just pay it off later. But it's something that's beneficial to be aware of. So I hope that you enjoyed this video around what is the cash value. It's money that you have access to in the policy, and then several follow-up questions we often receive around it. If you're interested in working with us, please check out our website, ibcglobalinc.com. And as always, I hope this helps. Thanks so much for watching. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.